When we look at a company like KP Energy, the real question isn't what's going to happen next quarter. It's what about the next 30 years? Is this actually a business that can quietly and consistently compound capital over the long haul? That's the puzzle we're here to solve.
And this right here, this is the central danger. Hype is where investment returns go to die. So our job today is to cut right through all that noise and separate the exciting story from the actual nuts and bolts of the business.
If you're thinking about putting serious capital to work in a sector like this, you absolutely need a framework. You need it to avoid that all-too-common mistake, the slow, silent death of your capital that happens when you chase a theme without really understanding the mechanics. And that's the framework we're going to build today.
So my promise to you today is simple: clarity. By the end of this, you're going to have a really clear-eyed view of how this business actually works, what the critical risks are, and what the real potential for reward is. We're not about comfort here, just the facts.
Most renewable companies, they look pretty profitable on paper, but very, very few of them actually generate real cash without just blowing up their balance sheet. So let's pop the hood and take a look inside.
Okay, so first up is EPC. This is the part of the business you always see in the headlines, the big project announcements, right? It gives you great-looking revenue and growth numbers. But this is not where long-term wealth is built. Think of it as the engine that builds the platform, not the platform itself.
Now the IPP segment, this is the heart of long-term value. This is where you're essentially turning the business into an annuity. You're building these 20, 25-year assets that just generate predictable cash flow. But this is also where companies can get buried under a mountain of debt. The key thing to watch with KPI is how selective and conservative they are right here.
And then we have the most underestimated part of the whole business, operations and maintenance. O&M is the bedrock. It's the recurring revenue from all those maintenance contracts that smooths everything out, that keeps the company stable, even when the big project business has a slow quarter. It's the silent workhorse. So the core logic here is actually incredibly simple. If the company uses the cash it gets from those big EPC projects to sensibly, and I mean sensibly, scale its own power plants and the maintenance contracts that go with them, well, that's when the compounding machine really kicks into high gear. And that's exactly the transition KP is in right now.
Now here's the part where so many people get it wrong. They look at the profit number, they see it's good, and they just stop there. They assume the job is done. But is that profit real cash, or is it just paper?
Let's look at the truth serum, cash flow. In a project-based business like this, quarterly numbers are going to be lumpy. They're going to be all over the place. The key is that over a full cycle, the cash flow from operations has to track EBITDA. It just has to. If it doesn't, those profits aren't real. As you can see with KP's numbers, there's a clear alignment over time. That's a very good sign.
So what stops KP from just being another commodity player? This is their real competitive advantage, their moat. And it's local. It's something that's almost invisible to outsiders. By controlling the land and the critical power infrastructure right there in their home turf of Gujarat, KP has real pricing power. A newcomer just can't replicate that overnight. It's a huge advantage.
Okay, so we've established it's a good business model and it has a moat. But here's the thing. A great business can be a terrible investment if you pay too much for it. So let's talk about the price.
This is a first principle of investing. You have to burn this into your brain. The theme can be fantastic, the company can be a star, but if the price you pay already assumes 10 years of perfect execution, your returns are going to be poor. It's that simple.
So where does that leave us with KP Energy? Well, it's not cheap. Let's be clear about that. The market definitely recognizes the quality here. But after a pretty healthy correction from its recent highs, the valuation is sitting in what I'd call a reasonable zone, pretty close to its intrinsic value. What does that mean for you? It means your returns are going to have to come from the business actually performing, not just from the stock getting re-rated higher.
So, it's absolutely crucial to focus only on what actually moves the needle on value. And it really just comes down to these three things: the cost of capital, management's discipline with debt, and the stability of power tariffs. Everything else you hear, it's just market noise.
Most renewable companies don't fail because of some big policy change. They fail because the promoters get greedy, especially after some early success. And that brings us to the single most important factor of all, the people making the decisions.
This leads us to a really critical point. Good governance isn't just about clean accounting in the past. It's about the discipline management is going to show with capital in the future. When the temptations of easy growth and cheap debt are everywhere, what are they going to do with that next dollar of cash? That question, that's the entire investment thesis, right there.
All right, pay close attention here. This is absolutely critical. We're talking about our non-negotiable kill switches. If you see any single one of these things happen, the investment thesis is broken. Period. You reassess immediately. No excuses, no let's wait and see. This is your single most important line of defense against a permanent loss of your capital.
Okay, let's pull this all together. We understand the business, we've looked at the valuation, we know the big risks, so the final question remains, should serious capital actually be put to work here or not?
And this slide really captures the entire investment case. The whole future of this company as a long-term compounder hinges on one single word: discipline. Cautious, cash flow-funded expansion. That leads to compounding returns. But a dead-fueled chase just for scale, that will eventually lead to collapse. It really is that simple.
So, how would a professional or an institution actually deploy capital here? Well, never all at once. You start with an initial position, maybe 30%, just to get in the game. Then, you watch. You add more capital only after the company proves its execution and cash generation for a couple of clean quarters. The final bit goes in either when the thesis is fully confirmed by their actions or when a market downturn gives you a much better price.
And that's really the final thought to leave you with. This is not a stock for chasing momentum or getting caught up in headlines. It's an investment that requires a business owner's mindset. It demands patience to let that compounding do its work, and it demands diligence to watch for any of those kill switches. Your attention is what will protect your capital in the end.